Life360 delivered a mixed quarter for Q2 2026. I mean, they beat on the top line, but they completely missed on the bottom line.
Yeah, the bottom line was rough.
Right, so let's look at the actual numbers here. Revenue came in at $159.0 million. That is a 38% year-over-year increase, comfortably beating the consensus estimates of roughly $156.7 million.
But the EPS printed at just 6 cents.
Exactly, missing the consensus estimate of 8 cents. And then we get to guidance. Full year 2026 total revenue guidance was merely maintained at $650 million to $685 million. And adjusted EBITDA was also just maintained at $130 million to $140 million.
Which the market absolutely hated.
Oh, severely punished. The stock crashed roughly 25% intraday, dropping from the 63 range down to around 50 immediately following the report.
I mean, the market's reaction here is a textbook example of what happens when a growth stock is just priced for perfection.
Yeah.
You have algorithmic models and institutional momentum, and when the company fails to deliver that expected forward-looking narrative, things break. It is exactly like a marathon runner setting a personal best in the first half of the race. But when you ask them for their updated finish time, they refuse to upgrade their estimate. The market was aggressively pricing in a guidance hike to justify the stock's premium valuation.
And when that didn't materialize, the structural floor just fell out.
Exactly.
Right, and that creates a massive disconnect. So we are looking at a stack of Q2 earnings transcripts, SEC Form 144 filings, and fresh analyst notes today to figure out exactly why a company that just crushed its user growth is getting taken to the woodshed.
We have to look under the hood of this earnings report.
Yeah, separate the headline noise from the underlying operational reality. Because to understand why the smart money threw a tantrum over what is objectively a very strong top-line beat, you have to transition to the segment performance. The user growth metrics they just posted are massive.
They really are. I mean, if you were looking at the raw operational scale, Life360 crossed a major psychological and fundamental milestone in Q2. They reached 102.4 million monthly active users. Yeah, that represents a 16% year-over-year increase. Hitting 100 million MAUs puts you in a very different echelon of consumer sauce. It changes your leverage with partners, it changes your cloud architecture needs, and it entirely shifts your monetization potential.
But raw users only tell part of the story.
Exactly. Active free users just burn server compute. Monetization is what the street actually cares about.
And on that monetization front, the conversion mechanics look incredibly solid. Paying circles grew 27% to 3.2 million. And that growth was fueled by a record 185,000 net additions in the quarter.
Which is huge for Q2.
Right. For anyone tracking consumer apps, you know the second quarter is often seasonally sluggish. Families are traveling, routines are totally disrupted by summer break, screen time habits shift. Pulling off 185,000 net adds in a Q2 environment points to a really sticky core product.
It does, and that flow-through to the top line is undeniable.
Cool.
Core subscription revenue hit $115.6 million.
Up 31% year over year.
Yep. And their annualized monthly revenue climbed 29% to $537.2 million. Those are robust compounding sauce metrics. But the absolute standout metric from this report, the one that jumps right off the page, is the advertising revenue.
Yeah.
It surged 315% year over year to a record $22.0 million.
Up 315%. I mean, you don't see triple-digit growth like that organically unless there is a structural shift in the business model.
Exactly. And what is fascinating here is the mechanics behind that surge. This ad growth is the direct result of their successful integration of the Nativo ad tech platform.
Right.
Management hasn't just been testing this. They successfully moved the Nativo platform from the beta phase into aggressive, full-scale commercialization. They are taking that massive 100 million-plus free user base and flipping the switch.
Turning it into a dual-engine model.
Right. They are fundamentally evolving from a pure freemium subscription model. By leveraging native advertising that blends directly into the UI, rather than relying on clunky banner ads, they are monetizing free traffic at a vastly accelerated run rate.
Okay, here is where I want to step in and push back on the underlying mechanism of that monetization. Because the report highlighted a highly specific and frankly startling metric regarding this Nativo integration.
So click rates.
Yeah. Advertisers are apparently seeing up to a 47% higher call to action rate using Life360's first-party data. Now, from a strictly financial perspective, I see a 47% CTA bump and think, well, that's an incredible conversion engine.
It is.
But if you think about the product architecture, this is a family location app. You are tracking teenage driving habits, school drop-off times, grocery store visits, commutes. When you leverage that hyper-granular deterministic data for ads that get a 47% higher click rate, aren't you playing with fire?
Oh, absolutely.
I mean, is this hyper-targeted monetization the ultimate validation of their sauce model, or is there a severe risk here of cannibalizing user trust?
That is the exact operational tightrope management is walking right now. From a purely financial perspective, that 47% boost is the ultimate validation. In a post-iOS 14 world where Apple gutted probabilistic ad targeting, first-party deterministic location data is the holy grail for advertisers.
Because they aren't guessing.
Right. Life360 isn't guessing where a user might be based on web cookies. They know exactly when a user pulls into a specific retail parking lot. Advertisers will pay a massive premium for that inventory, which is why ad revenue is up 315%.
But the churn risk has to be factored in. If the end user feels their highly sensitive family location data is being aggressively weaponized to serve them geographically triggered ads, the core value proposition of family safety gets entirely inverted.
And that is the exact vulnerability. If they cross the line from utility to surveillance in the eyes of the consumer, churn will spike and those 3.2 million paying circles will degrade. However, for this specific quarter, the top-line story remains pristine. The ad growth is spectacular, and user retention held firm. The real issue, the catalyst that actually spooked institutional investors into liquidating, is the cost of funding this growth.
Yeah, we have to transition our focus away from the top line and dig into the margins because that is where the bullish narrative completely falls apart. The margins are where the EPS miss becomes glaringly obvious. Let's look at the profitability problem here. Adjusted EBITDA looked great on paper at $31.1 million,
Hitting a 20% margin.
up 53% year over year. If you stop reading the income statement there, you'd think the quarter was flawless. But then you look down at the GAAP net income, and it actually dropped. Net income fell to $5.1 million, down from $7.0 million in the exact same quarter last year.
Right.
So revenue goes up by nearly $44 million year over year, but net income drops by almost $2 million.
The divergence between EBITDA and GAAP net income here is the smoking gun. The context surrounding that $31.1 million adjusted EBITDA figure is crucial for anyone modeling this stock.
Because it was subsidized.
Heavily subsidized. That $5.1 million in net income and the 20% margin were artificially propped up by non-recurring events. Specifically, the company recognized strategic tax benefits and a massive one-time tariff reimbursement.
And that tariff reimbursement is not a structural operational efficiency. It's a localized windfall.
Precisely. I mean, that tariff reimbursement alone positively impacted the EBITDA margin by a full 300 basis points.
Okay, let's unpack this. Without that one-time tariff check, the underlying margin drops down to 17%. That is classic, dirty EBITDA. It completely masks the true operational run rate.
Totally.
It's like buying a luxury car on a strict budget. You know, the features are amazing, it accelerates beautifully, but the routine maintenance costs and premium fuel are completely eating up your monthly cash flow. And the only way you made your payment this month was by finding a forgotten tax refund in the mail. So if the underlying earnings are actually weaker because they are being masked by these one-time events, where exactly is management spending this capital? What is driving the operating expenses up so aggressively?
Well, management is facing heavy OpEx pressure across the board. You don't support an infrastructure handling constant GPS pings from 102 million users without significant cloud compute costs.
Sure.
But beyond general infrastructure, we are seeing aggressive cost increases in R&D and sales and marketing. However, the primary capital sink right now and the explicit drag on their forward-looking guidance is tied to management's strategic shift in their hardware division.
Yeah, the hardware segment numbers were undeniably ugly. If you look at the Q2 breakdown, hardware revenue actually fell 20% year over year, dropping to just $9.8 million.
Yeah.
Furthermore, management took the opportunity to officially downgrade their full-year hardware revenue guidance. They lowered it to a range of $35 million to $45 million, down from their prior expectation of $40 to $50 million.
Which mathematically explains the guidance stagnation. The incredible $22 million beat in high-margin advertising was completely neutralized by the structural downgrade in hardware.
Wow.
They couldn't raise total revenue guidance because the hardware division is burning off the ad segment's excess momentum. But we need to analyze the strategic reasoning behind this downgrade, because it isn't simply poor execution. It is a deliberate, highly orchestrated pivot.
Because management is deliberately exiting brick-and-mortar retail distribution, correct?
Yes. Retail shelf space is notoriously expensive, the margins are thin, and the inventory carrying costs are a constant drag on free cash flow. So they are pulling back from traditional physical retail to focus almost exclusively on direct-to-consumer online channels, specifically timed with the launch of their new pet GPS tracker.
Right.
But the critical piece of this strategy is that they are willingly accepting an initial device-level loss on this new pet GPS hardware.
Okay, I see exactly how the mechanics of this play out. This is a classic razor and blade strategy.
Yeah.
You take a calculated loss on the physical hardware, the razor, or in this case, the dog collar tracker, because you know it physically locks that family into your digital ecosystem.
Yep.
You bleed a little cash up front on the device manufacturing and shipping to force adoption of a bundled silver subscription offer, the high-margin blades. Because once that hardware is attached to the family pet, the recurring SaaS revenue begins and the churn rate plummets because uninstalling the app now means losing track of the dog.
That is exactly the consumer psychology they're leveraging. Hardware attached to a pet creates unparalleled ecosystem stickiness. They're actively prioritizing long-term recurring SaaS revenue over near-term hardware profitability.
Makes sense.
And concurrently, management is aggressively accelerating capital expenditure into an AI-driven personalization engine. Building proprietary AI infrastructure is immensely capital-intensive, and those CapEx and R&D costs are hitting the income statement directly right now.
Which drags down that GAAP net income. But they claim this AI infrastructure is already generating tangible revenue impact. It doesn't take a leap of faith to connect those dots, right? The heavy AI investments are almost certainly the underlying engine processing that precise location data to drive those 47% higher call-to-action rates on the Nativo ad platform.
They are entirely interconnected. Management is choosing to compress their own operating margins today to build a vastly more lethal ad targeting engine and a stickier subscription bundle for tomorrow.
Right.
Strategically, for a company with a 5-year time horizon, it makes perfect sense. The problem is, Wall Street algorithmic models don't care about your 5-year time horizon when your stock is currently priced for perfection based on this quarter's cash flow.
Which brings us directly to the notable risks. I mean, a retail investor might look at 102 million users and a 315% bump in ad revenue and decide they're perfectly willing to wait out a messy hardware pivot. But the smart money was clearly heading for the exits, and the insider selling data backs that up.
We absolutely need to address the glaring red flags regarding insider activity, because institutional desks watch this data religiously.
Oh, yeah.
Recent SEC Form 144 filings reveal significant insider liquidations leading up to and during this transition period. Over the past 90 days, we've tracked over $6.5 million in insider stock sales.
That's a lot.
Crucially, this isn't just standard executive compensation rebalancing. This includes multi-thousand share liquidations by high-level corporate directors, specifically Charles J. Prober and Britt Morin.
Yeah, the Britt Morin filings are particularly aggressive. She sold over 10,000 shares in early August, effectively decreasing her total position by roughly 34%.
Exactly. When a corporate director liquidates over a third of their holdings right before an earnings print where management ultimately refuses to raise full-year guidance, the signaling to the broader market is devastating.
It really is.
It indicates that the people inside the boardroom understand just how expensive and margin dilutive this upcoming AI and hardware transition is going to be.
It's a terrible optic. You can't expect institutional investors to hold the bag and support a premium valuation multiple when the directors are quietly taking millions of dollars off the table.
And that dynamic synthesizes the broader market reaction we saw. It really comes down to a harsh, immediate valuation reset. Before this earnings print, Life360 was trading at a highly demanding multiple, a PE of roughly 29, while simultaneously exhibiting a relatively weak return on equity of just 6.8%.
Right.
Institutional investors were willing to pay that 29 multiple because they anticipated flawless execution, hypergrowth, and an inevitable guidance hike.
They were pricing in a perfect quarter. So when management failed to deliver that guidance hike and instead revealed a drop in GAAP net income masked by a one-time tariff check, those institutions aggressively repriced the stock to match the reality of near-term margin compression.
Yeah.
They realized the transition to this new ad-heavy, subsidized hardware model is going to be messy, and they simply aren't willing to pay a 29 PE while management figures it out.
Exactly. The multiple contracted to reflect the new risk profile. And we are seeing analyst adjustments across the street reflect this necessary recalibration.
Like Citi.
Right. While the overall street consensus technically remains a moderate buy, prominent firms are actively lowering their expectations and price targets. Citigroup, for instance, cut their price target from 66.65 down to 60.10.
Right.
They maintain their buy rating, But that target reduction is a clear mathematical admission that the timeline to sustained, robust profitability has been pushed significantly further out.
So synthesizing everything we've looked at in the filings today, here's the core tension for you to keep in mind as you model this company. Life360 is successfully scaling a massive 102 million strong user base and proving they can turn that free traffic into a high-growth native advertising engine. The top-line momentum is real.
It is.
But right now, they are trapped in the messy, expensive middle. They are dealing with intentional margin compression, taking calculated losses on strategic hardware pivots, and sinking heavy capital into AI infrastructure that is dragging down current earnings to fund a future ecosystem.
And looking ahead, I want to leave you with a final thought to mull over regarding the architecture of that future ecosystem. As Life360 continues to heavily invest in AI to parse incredibly precise first-party family location data, achieving those massive 47% boosts in advertising CTA rates, it creates a complex paradigm.
Yeah.
At what point does this hyper-targeted tracking cross the line from being a reassuring family safety utility into becoming a profound privacy liability for both the users abandoning the app and the advertisers relying on that data?
Make sure you follow the show for daily earnings coverage.